A lot of people think like closing the business feels like the biggest failure of their life. But hey, it doesn't matter because that happened to me. I spent 2 years on my previous startup, shut that business down, and it was the best thing that happened.
Now, I think about $1 billion in capital you raised.
Yep. And the way that you scale yourself to billions is every startup has that like hack that worked in the moment, but won't work again. If you look at Airbnb, they were crawling Craigslist. Facebook, it was like getting the Harvard parties organized. One of the things that all startup founders now should think about is like, what is the hack that 5-7 years from now, we're like, oh, that's the thing that worked. The problem with most people is they're like, let me wait till the dust settles and really learn what the best practices are. But when AI is changing so quickly, you have to value yourself on the speed of learning. And so it happens all the time. I tell an engineer, hey, try this new thing. And then 3 weeks later, it's a stupid idea. But the thing is, we're the ones that are going to create the best practices by learning all the bad practices. If you actually look at billion-dollar companies, and I see it over and over again, I've often bucketed startups into 2 different flavors. One is
Henry, welcome to the podcast show. It's great to have you here.
Thanks for having me. Excited to be here.
Yeah, the last time I interviewed you, I think it was 2 or 3 years ago now, virtual, and now we're here in SF in person. So it's great to see you.
Yeah, amazing.
So, Carta, you've been on quite, the wild ride in the last few years. But let's go back to the early days. How did the journey all, come about, and what was that kind of, founding moment for starting Carta?
I was working on a different startup that didn't go anywhere, shut that business down. And I like to tell that story because I've been talking to founders recently that have, shut down businesses and sending me emails, for angel investments. And I know how hard a time it is for many of them. And I whenever I get that email from a founder or an angel investment, I tell them my quick story. That happened to me. I spent 2 years on my previous startup, didn't go anywhere, and it was the best thing that happened because I ended up doing Carta next. And somebody said to me at the time that I found really helpful is the kind of the old proverb, it's darkest before the dawn. So I tell that story because I think for many founders, closing the business feels like the biggest failure of their life. And if you're a real founder, it's just another thing you do as part of the journey of being a founder. So out of that company, I ended up working with one of the investors that I had worked with on the last company. We looked at this cap table problem, and he said, hey, if you'll start the company, I'll invest in it. I think it's an important problem to solve. I was a founder without an idea, so I would work on anything to start a company again. And that seemed like the most reasonable idea I could come up with at the time. And it turned out to be a better idea than I think all of us thought it would be.
So take us back then. 13, 14 years ago, right? Technology was completely different. How were people doing cap table management back then? Was it very paper-based?
Yeah, it was all paper-based and Excel. And one of the interesting things about what we did in 2013, 14 was the problem that cap tables had back then was the source of truth of the cap table was on the paperwork that the company issued. So Ali, if you were working at my startup, the source of truth was I literally gave you a piece of paper that said, you get 100 options in my company and you sign it and I sign it. And that's the proof that you own the 100 options. Seems reasonable. Yeah. How that was actually managed at scale, of course, was everyone would then take that paper, put in a filing cabinet, and type it on a spreadsheet. And everybody operated off the spreadsheet, the data, but the source of truth was still in the paper. And that created all kinds of problems, of course, reconciliation. Did we actually capture all of it? What happens if there's vesting? We have to update the spreadsheet, but the language and rules is captured in the paperwork, but it's not actually doing the calculation. And that was really the problem we solved was we inverted the problem. So instead of paperwork being the source of truth that you then recorded in a spreadsheet or a database, we said, come to Carta, type in 100 shares for Ollie in our database, and then we'll generate the paperwork that you send to them. Mm-hmm. And that's all we did. It sounds really simple. That's all we did was we inverted the world from the source of truth being paperwork to the source of truth being data. And then paperwork was the execution of that data. The reason I tell that story now or today is because one of the things we think a lot about is 10 years ago, we flipped the world from paper to data. Now with AI, we think a lot about, is that actually going to flip back? Because now we can ingest paperwork and structure the data at scale, which we could not do 10 years ago. We could not take all the paper documents that a company had issued, dump it into a box folder, and suddenly reconstruct a cap table. We just didn't have the technology for it. Today we do. And does the world invert itself back to, hey, we can go back to a world where a source of truth is now on paper, and then we can reconstruct data from that. And we are seeing that now in many parts of our business. For example, in private equity, the source of truth for private equity transactions are very complex legal documents explaining the investor classes and waterfalls. In our fund accounting business, the source of truth is very complex LPAs and legal agreements, which we don't have a way to structure that data. But with AI, we're now able to. And I just tell that story because it's, we took advantage of this seismic shift in technology and, starting in sort of 2010 of open source and cloud. And now we're taking advantage of the shift in technology with AI, and the world's flipping upside down for us.
Yeah, this whole AI space, 2-3 years ago, it wasn't really that massive a hype, right? And it just changes every freaking day. What do you make of what's happening?
I'm having the best time I've had at Carta in a long time, and I'm now the CTO of Carta. I run all of engineering. Half my day is spent with engineers. I've tried to push a lot of the commercial responsibilities to the exec team, so I can spend more time on technology. And it's for a couple of things. One is figuring out how to use AI is actually a very creative exercise. It's very hard. There's many people doing it wrong. We think we have a perspective on how to do it right. But it's something I think that has to come from the top down. It's not going to be incubated internally. It's got to be both thought of and executed from the very top. So I spend a lot of time there. The other thing is, because it's changing so quickly, the problem with most organizations, especially large ones, is they value themselves on sort of what they accomplished, right? You're like, hey, I built the feature, I shipped the thing, I sold the product, whatever it is. And it makes sense. That's very rational. But when AI is changing so quickly, you have to value yourself on the speed of learning. And so it happens all the time. I tell an engineer, hey, try this new thing. Try Agno workflow, right? Try N8N and plug it directly into our general ledger database. Try these things, and then three weeks later, it's obsolete or it's a stupid idea. What was a good idea is now a stupid idea. A typical, middle manager would say, "I wasted my time. That's going to be a negative on my performance review because I didn't get anything out of it." But if the CEO is like, that was actually time well spent because we now learned how to do that and we decided this is not the way we want to do it, but because we did the exercise, we understand how this stuff works. The intellectual capital we're building at Carta is incredibly valuable, but only the CEO can really say that. No performance review system will value that. And so that's why I'm spending a lot of time with AI. And that's, to me, why the rapid transition of it, for many people, it's a reason not to do it because let me wait till the dust settles and really learn what the best practices are. And our view is we're the ones that are going to create the best practices by learning all the bad practices, and we'll figure it out.
It just keeps changing every 5 minutes. So we actually published one of the first generative AI market maps. This was 2 days after ChatGPT came out. The thing had 250,000 reads in a week. And then a whole year later, we had kind of AI agents, maybe 18 months later, AI agents. Now it's vibe coding. It just keeps changing and changing. Where do you see the space going next? And what impact is AI going to have on Carta itself?
So I'll talk very specifically about where we use AI, because AI is a very broad, horizontal problem set and solution space. And we use it for a very specific use case, which is how to use AI in accounting realms. And that's what we think of ourselves as. We build accounting systems, whether it's cap tables, which is a debits and credits system for equity, or fund accounting, which is actually an accounting system, or it's LP portfolio analytics, which is a liability accounting system. So we do accounting, we do numbers. So how do you use AI in this numbers world? And most of the work that we're doing is figuring out how LLMs can write code that do accounting. So it's not can LLMs do accounting, but can LLMs write code that does accounting? And the reason is LLMs are stochastic, accounting's deterministic. You have set rules, and we want if we're going to run an accounting computation a million times, we want it to come up with the same number every time. An LLM does not guarantee that. What we think is really the unlock in our world is we often describe LLMs as an English compiler to assembly code. So you can think of a Python compiler. I know it's not a compiler, but it's an interpreter. But think of it the same. Python compiler translates Python into assembly, and you run it on a computer. LLMs allow us to write English and compile it into computer instructions. And what's incredibly powerful about that is now anybody can program a computer, including our users. So one of the examples that we do is we solve problems that have like complex accounting rules. Like, hey, how do you allocate these expenses across all these private equity firms that we're working with? It's a complex rule. You have to you need a developer to write the Python code to do it. LLMs are very good at writing Python code. And so now we actually expose to our users, they can tell the LLM what kind of rule that they want in this expense allocation example. And then the LLM will write the Python code that we then run on their behalf. And more what we think is going to happen is our users aren't going to be trained on clicking buttons or filling out forms. What they're going to be trained on is, hey, I'm just going to tell it what I need it to do, and we will generate Python scripting language that will then run on their behalf.
It's crazy, right? And this is all just happened in the last 2 or 3 years. But it's maybe take a step back. So Carta's been going 13 years, but like every company out there, it all starts from somewhere. Getting into your first couple hundred users, how do you go around doing that? So other founders, listen to this podcast, can, maybe get some ideas on how they can land there first.
Yeah. So I had a hack, which won't work today, but I'll explain the hack and I'll explain why it doesn't.
Are you saying you're old school?
Yeah, no, I was just saying like the world has changed considerably. When I, was doing this, the hard part, of course, for us was we couldn't raise any money because everybody was like, the market size is too small. But I'd run around to all these VCs and pitch them on, hey, I'm doing this cap table thing. And they, great idea. I'm sure, it'll be good, but, you'll make $3 million a year and it's a lifestyle business, but, it's not venture. And I say, I understand, but hey, would you be willing to do this? I do 409A valuations as well. And I know your portfolio companies spend like $5,000, for every 409A valuation. This was back then, $5,000 to $7,000. And I'll do it for like $1,000. And all you have to do is just I'll give you a custom code. And if you send this to your portfolio company's CEOs and they come to me, I will honor the code and I'll give it to them for $1,000. It would be super cheap. And of course, because the VC now wins, they get to get a discount for their portfolio companies. It looks like they're adding value. They're doing me a solid, and they want to be helpful. Like everybody wins. And so I'd literally just run my fingers across the keyboard and make up a random number. And I would email it to them. They'd say, thank you, Henry. And they'd forward it to their, CEO, a Google group thing. And then I get 30 emails, forwarding it to me going, hey, my investor sent this. Can we get a discount? And that just created this viral loop. And it was how we got going. It won't work anymore because now that's way overdone. Every startup, every portfolio company is asking their investors to get them customers. Doesn't work anymore. But back then we were the only ones because nobody was selling to startups back then. But the reason I tell that story is I think every great company, if you look at Airbnb, they were crawling, Craigslist. Yeah. Facebook, it was like getting the Harvard, parties organized, like every startup has that like hack that worked in the moment, but won't work again. There's a moment in time that it works. And I think one of the things that all startup founders now should think about is like, what is the hack that 5-7 years from now, we're like, oh, that's the thing that worked. And it's going to be unassuming. It's going to be non-obvious. You'll only get there by experimenting and trying to figure out what works. And that will be the thing that unlocks it. Yeah.
I kind of feel though, the beauty of something like Carta is you're catering to startups, right? And as soon as they raise, they're going to tell all of their friends about it. And the good thing is there are not that many, competitors out there, right? Anymore. So it's kind of, you have that insane viral network effects. How has the customer acquisition kind of channel changed over the years? Now, is it very much you are kind of the market leader and people know about it? Or is it still very much word of mouth and so on?
It's definitely an ecosystem go-to-market model. So I would say for us, the startup thing is both good and bad. It was good that we sold to startups because they were willing to try something new. They were adopted. It's a small ecosystem. You have a 10x better product. Word spreads quickly and all of those things. So that's super positive. The problem, of course, is it's startups. They go out of business a lot. They don't have a lot of money. 90% don't go anywhere. It's a very difficult space. One of the things that I think I feel a little bad that we did a disservice to many companies is because Carta was successful at building $1 billion business, selling to startups, everybody else thought they could too. Like, oh, we'll just build a, they're the easiest customer. They're the best. If Henry could do it, if Carta could do it, anybody can do it, right? It's like, but if you actually look at how many $1 billion companies that exist selling only to startups, we're the only ones. We're the exception that proves the rule. Startups always were a bad customer base, always a bad market, and always will be. You have to have a very unique niche to win this market. And what I always encourage founders, in my angel investments or whoever I'm talking to is, if you have to sell to startups to kind of figure out the product, go for it. But go outside startups as quickly as you can, because it's very hard to build a big business selling to startups.
Yeah, we're seeing maybe a few companies. I mean, if we take startups and SMBs together, there's probably HubSpot, Zapier, if you count that, like also catering startups, you guys. But really, apart from that, not much, right? What was that kind of relentless just ambition to keep going? If people are saying, what are you doing? Don't sell to startups, like go and chase other money elsewhere. Why did you just focus on the product, which was for startups?
So we always had this, go deep and narrow versus broad and shallow. And so it wasn't just sell to startups. It was how deep in the value chain of a startup could we get to? So 2 founders and a dog, doing founder stock, then it was preferred stock, then it was option grants, then it was 409A and stock option expensing and QSBS and Carta total compensation. We just kept adding more to the stack there. Very quickly, we also learned, hey, we think we can help the venture funds. We're tracking all their investments. We should be able to help them somehow. And that became our fund administration and fund accounting business. And that actually, a lot of people know this, grew faster than cap tables. It's only a 5-year-old business,
really,
but it grew. The first 5 years grew faster than the first 5 years of cap tables, and I think it's going to be at least as big, if not bigger, soon than the cap table business. And so one of the going back to my early start about, hey, I was a founder without an idea. I just wanted to be a founder, so I grabbed the first reasonable idea I could. There's many disadvantages in that, but one of the advantages is I'll work on anything that moves the startup journey along. And so there's no problem too mundane, too small, too boring. Like I'll do anything to move the business forward. And so we've just been very good at concentrically growing from a small base of cap tables into now we're in fund accounting and LP management and private equity and loan servicing and private credit. It just keeps expanding from that.
I kind of feel like we were talking about this before we came on. Once you have the startups and you have this ecosystem of people, you can sell so many different products. How would you think about building products and how would you be disciplined around doing it? Because you could be like, let's go launch everything, right? But you have to be focused.
Yeah. I think it's really the temperament of the founder and the organization. So, one person's focus is another person's myopism.
Yeah.
And so our view, I've often bucketed startups into 2 different flavors. So one is what I'll call execution startups. So think, like the Rippling, the MongoDBs, these companies that have a product that they have clear line of sight to $1 billion in revenue. Like it's, they know exactly what to do, right? If Rippling builds a better HRIS, there's billions to go after. They just have to be better than everybody else. And I call them execution startups. We didn't have line of sight on any single product to billions in revenue. So I call us an innovation startup. We had to innovate on one thing, use that to innovate on the next thing, to innovate on the next thing, and keep going. And that's just true of us. And so if you're a Rippling or MongoDB, you have a database and just build a better database and you scale yourself to billions. For us, we had to keep building new products. And the way that MongoDB should focus on building the best database in the world, we actually need to diversify and build a lot of different products because otherwise we're going to run out of oxygen. So it really depends on the company and founder.
Yeah. Well, there's some of the products that maybe haven't worked as well as you had hoped.
Oh, like all of them. I mean, I would say on average, I've probably got, I'm hitting one reasonable product for every 8 attempts.
Okay, so for every product you launch, you said one works?
For every 8 products I've tried, one really works. Mm. And so it's very interesting because venture is power law. The top company outperforms everything else. even within the company, products are power law. One product dominates everything else. And so one of the things we think a lot about is if you're going to launch a lot of products, you have to take a power law perspective to it. You might launch 6 products, 5 won't go anywhere, but if that one gets to 100 million, it's totally worth the 5 that didn't work. But you do need to get to that one. If you do 6 and none of them work, that's a big problem.
I think it's very normal, like in startups as well, right? It's you try every product until that one works. Okay, let's talk about maybe what's happening in venture capital. Lots is happening in like the VC ecosystem. What do you make of kind of what's happening in the world of venture right now?
There's definitely, a category shift. I would say, there was the explosion of social media, in the early 2010s, Instagram, WhatsApp, Snapchat, all of those things. And then we started getting the vertical B2B software explosion. Then we got the fintech explosion, and now we're in the and then I would say through COVID we had the distributed work cloud explosion, and now we're in the AI explosion, and you see these companies that exploded. The winners are separating from the losers. There's not that many winners. Many are losing. They're losing slowly because a lot of these businesses are relatively capital efficient. And so, they got to $20 or $30 million, but they're growing 20%, cash flow break even. They're just kind of limping along, which is probably the worst place to be. You sort of want a company to go to zero or go to the moon, but you don't want 20 million static. And so there's just a lot we're working through in the backlog of companies that didn't work out. But now all the money's going to AI. I think the same thing's going to happen. There's just like B2B, overfunding, too many AI companies. There'll be a handful of winners. There'll be many, many losers. It will take a while to work through all of that, and we'll see what the next phase is.
It's kind of crazy, isn't it? I mean, like I've been meeting some of the companies here in SF this week. Some of them are 8 months old. They're generating $10 million in revenue already. Are we in an AI bubble?
I mean, for sure. But I don't view it. I think it's like this provocative, like, oh, that means it's going to pop, all that kind of stuff. It's just, it's very rational. What I think people don't completely understand is like, as a group, we may be irrational, but individually we're rational. You're an investor. We are funding all of these startups. You place 10 bets. 9 of them are not going to work out. For sure, and you overpaid. But the thing is if it's not going to work out, it really doesn't matter if you overpaid or not. And then if you get one that's anthropic, it doesn't matter if you overpaid. Yeah. And so it's very rational, but it does inflate everything. Yeah. And then when we have clarity on what's working and what's not working, all of that stuff will pull back. People will, people are making investments because we don't know what's going to work yet. But they want to be ahead of it. And then when they figure out what's going to work, they will get more precise about what they invest in. The companies that don't work will go out of business. Everyone will laugh at them and say how stupid they were, but they weren't. You're only stupid in hindsight. But in this moment in time, it's very hard to predict the winners. So we're absolutely in this exciting phase. Most people view it as a bad thing. I think it's great. Right. Yeah. It's what creates funding for more startups and all the startups behind us. Yeah.
It kind of feels also just in the AI space, just how quickly like it's changing. But I think like something relating to what Carta's also working on, especially these companies who generate hundreds of millions of dollars in revenue, they start to do secondaries for their employees. Why is it important for companies to do this? And for companies who are kind of at that stage who might be listening, when do you think is the right stage for those types of companies to start offering their employees to participate?
We do a ton of these tender offers or secondary programs for the companies. It's all dependent on where the founder is and kind of the founder philosophy. I mean, there's some founders that all the metrics that suggest they do secondary and they just don't believe in it, and there's others that are like, metrics may have not suggest they should do a secondary, but they philosophically believe it's important. I don't think there's a golden rule to it. I do think there's an argument to be said that the CEOs that have companies that are strong enough to support a secondary tender and do it will have an advantage in recruiting, because employees will trust that CEO and want to go work for that company because they will get some early liquidity. There is this very strong problem, though, or conflict that happens, which is if you're a great company going to the moon, you have all the ability to do a tender offer, and that's also the company people should not sell stock in. And so that's always the challenge on this. And then the company that's not doing that great, that's the company people want to sell stock in, but people don't want to buy. And finding that meeting point of the bid ask is the challenge in these secondaries.
Yeah. A lot of these companies, it all starts from somewhere also, right? And, quite a few of these startups now are raising millions of dollars in revenue, like very quickly, and also millions of dollars in capital. Carta, you guys, 13 years now, I think about $1 billion in capital you raised, give or take.
Yep.
Take us back to those fundraising meetings, the relentless hustle. Why did you not give up? And how much did it take to get your first rounds closed?
Oh, it was very tough. The seed round was really tough. The feedback was always market size is too small. Cap tables isn't a very interesting problem. The seed round was really hard. In fact, the only reason we did the seed round was we pitched secondary markets. Like we were going to build a NASDAQ for private markets, but we were going to do cap tables first, and that would be the wedge product into building a secondary exchange. And so the only people that really funded the seed round, they weren't really investing in cap tables. They were investing in the stock market idea.
Yeah.
But it was super tough. I had learned the hard way through the previous company how hard fundraising was. So as hard as I describe it was for eShares, it was way easier than the previous company.
Yeah.
And so for me, it was just, you just kept grinding. And, we raised, at the time, it was a reasonable seed round. It was $1.8 million. I raised it 25 to 50K at a time, going, this is like old school. But I remember, having to do pitch competitions on a Tuesday night, where in a law firm conference room where all these amateur angel investors were hanging out, drinking beer, eating popcorn, watching these pitches, and would throw 5K into the bucket for you. And that's how we raised money back then, whatever it took.
One of the trends I'm also seeing in venture capital is a lot more angels coming in, or people actually starting their own funds, former operators, former founders, these $10, $50 million funds. Do you think this is the new trend? Are we going to start seeing more of them? Or is it, are we in a hype cycle and maybe there's just not going to be so much of them?
We see a ton of them. It's one of our top customers at Carta. Like our number one customer is founders that need cap tables. Our second is emerging managers that need fund administration and fund operation software. And so we see them all. Big fans. What we're really seeing in the market on the VC side is it's becoming bimodal. And so the bigger funds, the Andreessens, the Sequoias, they're just getting bigger. And then we're getting many more smaller funds. The ones in the middle are the ones that are struggling. And it makes sense. Scale, is in capital markets, scale begets scale. So you expect these the bigger firms to continue to compound. And then on the lower end, what keeps them in market is these early stage venture funds, they have some niche that they can exploit. So like the classic is, we just had a couple of Carta employees leave and start their own funds, small emerging manager funds. And their niche is they know anything related to Carta. So their specialty is ex-Carta employees that go to start. They're always the first check into that. Anything that integrates with Carta, they're the first check into that. Anything that is the Carta for something else, they're the first check into that. And that's their niche. The problem, of course, is how well does that scale? How many Carta of something? How many ex-Carta employees? And so there'll be many of these emerging managers that can take advantage of a niche. Not many will be able to scale those and sort of cross who's building the next Andreessen Horowitz? That's a very difficult question to answer. But I do think there's just going to be bigger, Andreessen Horowitz is going to keep getting bigger and bigger, and you're going to have a lot of emerging managers. The middle is where the chasm's going to be.
Yeah. Do you think these emerging managers can become the next A16Zs, these Sequoias of the world? Because these firms have been around a long time. And I'm kind of thinking there is, partly the future of venture capital. Is it going to be all around being hyper-focused, distribution also a big thing? What do founders need now? They need customers and they want distribution.
Yeah. I think it's going to be very hard to build the next Andreessen Horowitz. And not that it was easy to do it then either, but because venture is achieving such scale, the problem with a seed fund today is in the larger venture firms, like the Sequoias, the Andreessen Horowitzes, the Lightspeeds. The seed funds are lead gen for the growth funds, and so because they make all their money on the growth funds. So the seed funds are lead gen, which means they can subsidize the seed funds. The seed funds can pay a higher price because they don't care as much about the economics of the seed fund as long as it gives them rights on the growth fund. So now, let's say you're a VC with a seed fund, but no growth fund. You're a small emerging manager. How do you compete with a competitor that goes, look, I don't need to make money on the seed fund. I can outbid you on anything I want to win because I'll actually make money on the growth fund. And so that's why I think it's going to be very hard for these emerging managers to reach scale, which is why you see a lot of pre-seed funds, basically I'm going to write the first 50 check, the K check, the first 100K check. They're really trying to get in before the seed funds come in. You don't see very many first rounds being built right now that are pure play seed funds.
Yeah, it's super interesting. I think this is a space to watch. I think especially like the emerging managers, operators like becoming angel investors, right? I do think like one thing this AI hype cycle maybe creates, there's going to be a lot more companies like starting, operators becoming angel investors, and maybe like this is a really interesting like flywheel network effect. The question is, how many of those startups become successful? Obviously, right? We mentioned A16Z, Marc Andreessen, who sits on your board. How did you first meet him, and what's the greatest lesson you have learned so far from him?
So I met him in our Series E about a year before a Series E round. And Andreessen Horowitz had passed on the earlier rounds, and I finally got sort of the attention of
you got a conviction.
It was actually a guy named Alex who runs their growth and fintech platform, who's one of the smartest fintech investors. Or I shouldn't say one of. He is the smartest fintech investor I've ever worked with. So anytime I have a question about fintech investments, he's the guy I call. Anyway, I got to know him. He brought us into Andreessen Horowitz, and I got to meet Mark and got to know him over a 6 to 9 month period. And I remember the first time I met him, we walk into his office talking about the business. He had this nice office over on Sand Hill Road, and at the end of it, he goes, "We're very interested. Let me write my phone number for you." And on the back of his business card, he writes his cell phone and he hands it to me, and he says, "Call me anytime." And I said, "Thank you. But Mark, I got to ask, you got, this is my Series E round. Your firm passed on every round before then. What happened?" And he goes, "Sometimes we make big mistakes." And I was like super impressed, and he talked about why they make mistakes, what kinds of mistakes they make. What they learn from the mistakes they make. And it's something I so admired about working with him is not just the incredible intelligence, but the humility around how hard what we do is.
I read in one of the interviews, you see him once a quarter or something. Yeah. And, for founders who are thinking about structuring their board as well, when did you decide it was the right time to structure your board and actually like create one? Is it post Series A, Series B? How does it work?
I think if you're raising venture capital, kind of the board construction gets forced on you. Every time you raise a round, they usually try to get a board seat on it. Yeah. So the board construction sort of gets built on top of you. Where you start to go outside of kind of just investment board members is usually when you decide, hey, when do I want to add an independent? And I think, for us, we started, we asked our first independent, Michael, after Series B, he joined. And it's been fantastic. He's an industry expert, and he's still on the board today, 10, 11 years later. I think one of the things that a lot of founders do is they don't add independence very early, understandably, because they're like, well, I'm a Series A company, I'm a Series B. I already got 2-3 board members I don't want. Why would I just add more? And so they just don't want to do it, and they postpone it. And there's an argument to be made, like, keep your board small. The other side of the argument is your board members on the investor side have different incentives than what a governing board or like an independent would have. And at some point, you get outnumbered by the investors. And that's actually when you should, or before that happens, start bringing in some independents, because ideally, really, the independents are aligned with you. They're aligned with common. And a lot of people don't think about this when you're just building the company and you're growing. I see this come up often. We've done 11 acquisitions. We've got 2 more coming this year. A lot of these are startups. The biggest problem we have in acquisitions is seed stage, early stage investors. When they come in with a check, they are very founder friendly. When it comes to sell the company, they are not. And I can categorically tell you, every time a deal has gone bad and a founder has gotten screwed over in M&A, it's the seed founders that screw them over. Because there's no reputation, they're not Andreessen Horowitz. There's no reputation. They're just another seed founder. There's another GP. This is probably one of their only exits that they've ever had. And their job, and they will hide behind fiduciary duty, their job is to extract every penny they can out of it. And you hear them on the way in, we're founder, we support the founder. And on the way out, they do not. And I see it over and over again. I actually think, it's hard to do this, but when people ask, like, how do I do diligence on investors? I would not diligence founders that have had the investor invest in them. I would diligence founders that have had the investor invest with them and they exited with them. Because that's when you can tell if an investor is good or not, is at the exit.
That's probably like a really interesting product you guys could launch, because you have the data, right? Maybe it's coming soon, I don't know. But that would be just so useful for founders.
It's less on the data and it's more on what they will block and get in the way of. So, for example, we've had deals where we work with the founder, we agree on the deal, and we have X dollars, for the company and the cap table, and then we reserve Y additional dollars as incentive interests for the team and the founders, to stay on top of the cap table. And the seed founders will go, well, hey, if you're going to pay, that should come to us too. Like, that should actually go to the cap table. Like, you should pay it, split it. And that happens all the time. It is remarkable how bad some of these seed founders treat the founders on the way out.
Yeah, it's not good. Like, we see it a lot as well. Founders, they have a super good exit, but actually in reality, they get nothing. So if you could give any, tips for founders, who are raising, what would it be? Have a good, clean cap table and just have good friendly terms.
I think so. I think friendly terms. I would say the best diligence you can do for an investor is ask for a referral to a founder that the investor invested in and they exited, and talk to that founder about how the investor was at the exit. That's the best indicator of what they're like. And if they go, well, I've never had one, that's also another interesting data point that they've never had an exit.
Okay, so part 2 of our show is talking about tech trends. And I've seen quite a few of your interviews recently, and some of the trends I think you're really excited about. And it's all around kind of like private equity, right? What's happening in the world of private equity in terms of trends and insights? And what are you most excited about now?
Two things are happening in private equity. One is the asset class itself is what I'll describe as professionalizing. Private equity 20 years ago is like venture today. It's sort of a shoot from your hip type. It wasn't. Most of these firms aren't really run like real businesses. They're just kind of deal makers. They're not really. They don't have a systemic way of how do we build this as an asset class. I think venture is starting to get some scale, but it's still in its infancy. Private equity was like that 20 years ago. Private equity now is really becoming an industrial growth engine. I mean, it is becoming a true asset class, and these firms are professionalizing and bringing in management teams and running better. So that's one thing that's happening. The second thing is what I'll call the retailization. So private equity is accessing retail investors through these things called semi-interval funds or interval funds or semi-liquid funds. And so you're just seeing the asset class become democratized and getting much, much bigger. When we feel like we've got a good established mature business in venture, Now we're spending all our time in private equity, and private equity. It's early days for us, but it's the fastest growing part of our business, and we view it as 6 to 8 times the size of venture. And then if we look at private credit, which is the next kind of domino for us to go after, that is an additional 3 to 4x the size of private equity. And so these TAMs just get bigger and bigger the further you move away from venture. We're in San Francisco, so our world is venture. But if you get outside of San Francisco, the private equity asset class is enormous.
And so for the private equity and credits, you would focus globally or?
Yeah, so we have 150-ish people in London. We got 60, 70 people in Singapore. We just opened an office in Abu Dhabi, one in Hong Kong. I think next month we're opening in Luxembourg. So we're moving the chess piece, the global chess pieces or risk map is starting to get filled out.
Super interesting. I remember using Carta 7, 8 years ago. So maybe only 5 years in. And although such an amazing ride so far, it kind of feels you still have so far to go. There's also a really exciting time, right? You raised $1 billion, over $1 billion in capital. What comes next is the question, I guess.
Yeah. The thing that we figured out is the playbook we brought to venture, which is, hey, put the company on Carta platform to manage their cap table, and then use that relationship to put the fund on Carta fund administration, fund accounting to manage the fund, and then use that relationship to put the LPs on Carta to manage their investments. That playbook worked really well in venture. What we figured out in the last couple of years is it actually works really well in other asset classes, anything alternatives, anything private. And so we're just stepping through private equity, now private credit. Who knows? We could go into energy, infrastructure, real estate. There's a lot of things that we're looking at. But private equity, private credit is the current focus. The other thing we learned is in 2021, 22, we decided to expand internationally. And so I jumped on a plane and I flew around the world learning about venture ecosystems, all corners of the earth. What we learned is venture is a pretty US centric asset class. Yeah. If venture is a small asset class in the United States, it's tiny anywhere else. But private equity is not. Private credit is not. Most of the world runs on private equity and private credit, not on venture. San Francisco runs on venture. And so the kind of combination of taking down more asset classes and becoming a global platform kind of converged in the last couple of years. And that's what's been working really well for us.
I mean, you've also got to the scale, right? It's a couple thousand people globally. What's the hardest part now of being the CEO? And what's a typical day for you?
I don't know if there's a hardest part. It's all fun. It's all not
fun.
Yeah.
There are days when it's hard. And this is surely
Marc Andreessen calls it, being a founder is chewing glass till you like the taste of your own blood, and I think I just kind of like the taste now. Yeah. So it doesn't, there's no one day is worse than the other. It's just the thing that you do have to accept is I think a lot of people think oh, you're 2,000 people, you've made it. It gets easier. It gets harder. It's not, the problems is just bigger, but it's the same stuff. It's just every morning you walk in and there's a huge set of problems. What does get easier is I expect it now. When I was an early stage founder, I'm another problem? Come on, how many do I have to deal with today? And you're Series A, another, when does this stop? At Series B, and then you get to this point and you're if I don't have problems today, that's weird. That's a weird day, And so you just expect it. And so I think, I will say maybe the better version is the most fun part is, working in small teams, whether it's my exec team and we're trying to wrestle with a problem, whether it's a handful of my AI engineers who are trying to try something new. It's the best parts are when we get the best and brightest at Carta. I do this thing called Carta Business School once a year where I bring the top 30 young managers to an undisclosed location, and we spend 3 days together working on the hardest problems at Carta. Like that's the stuff that just, I still have to do legal and HR and compliance and finance and board meetings. Like, that's just part of the job. But the funnest part is like a small team of super talented Cartans together with me working on something fun. Like that's the best part. Yeah.
And how good does it feel or does it annoy you when, current employees come to you and say, Henry, I've had an amazing 2 years, 5 years, but I want to go start my own company?
Oh, it's the worst. I mean, it drives me crazy. It happened last week, and it happens all the time. And I always tell them how awful it is to be a founder, and it's not fun at all. And you just have problems after problems, and they should never do it. But they do it anyway because good founders will not listen to advice.
Exactly.
If I talk them out of it, they weren't going to make it anyway. It happens all the time. I think this is like another one. I remember when I was an early stage founder, people would quit, and I would take it so personally. It was so hard, emotionally hard. 2,000 people. We have 2,000 people. We have 50 people a quarter quit. We have a goodbye channel. They all say goodbye. And we have they tell what it was like, and to keep in touch and what they're going to go do, and all those kinds of things. And now like I'm not hurt, I'm not upset. I look at that stuff really nostalgically, and it's like it's special. And sometimes they come back. We have a lot of people that come back after they start a company, it doesn't work, and they'll come back, or they go to a new job and they want to come back. And I think once you accept it's miserable, it stops being miserable.
Building a company is freaking hard, as we know. But if you could look 5 years ahead from now, where's Carta going to be? What are you most excited about next?
I feel like I was an early inventor and technologist in 2012-13 around the intersection of cloud, open source software, and legal tech. Like that was cap tables for me. I invented new things. I felt like I was an inventor, that because of technology and my understanding of technology, I could solve problems other people couldn't. Until the last couple of years with AI, or last year with AI, I felt more like a business person. Like I ran a business. Now with AI, I feel like an inventor again. I'm learning. Every day I'm learning. I'm like, to your point, AI is changing every day. Every day I'm learning, and I'm trying new things, and I'm inventing new things, and I'm working with teams to invent new things. And that's super exciting. And my hope is, 5 years from now, you'll see Carta. We will have invented many new things that the world has never seen before. We will be able to do it because of the technology shift that's happening, and we're on the forefront of it. And that's gonna change the world in our way. Every founder is building a company that changes the world in some way. And I don't even mean some like, noble kind of newspaper thing. It's just, if you make your customers' lives better, you're changing their world, you're changing their lives. And that's what we do every day, is make our customers' lives a little better.
Cool. Well, look, really excited for you. It's been probably a long 13, 14 years. Looking forward to see where you go next in the next, 13, 14 years. And who knows, right, what's going to happen in a few years.
Super. Thank you,
Cool.
Ollie.
Thank you so much.
Thank you for having me.